The following is a presentation of the ILR School at Cornell University. ILR, advancing the world of work.
Hi, I'm Kevin Hallock. I teach here at Cornell's ILR School, and I'm happy to welcome you to our webinar today on Are the Jobs Ever Coming Back? Today I'm joined by Stephen Berkenfeld and Frank Koller, who I'll introduce in a few minutes after we do some preliminaries. I'd like to start by giving you a couple of technical details. There are three. First, I'd like to ask you to make sure you only have one browser open, because if you have more than one, you may hear some feedback in the audio. Second, if you see the video freeze at any point during the session today, just refresh your browser and things should straighten themselves out. And third, we're going to take questions during the webinar. We'll try to do that. If you'd like to send one, click on the icon that's second from the left at the top of the video player in your browser, and an icon will appear that looks like a cartoon thought balloon. And in there you can type in your question. Some of those will appear here on the screen for me, and if you'd like to tell us who you are and where you're writing in from, that would be wonderful. So I'm going to start by setting the stage with a couple of labor market statistics from the U.S. for just a couple of minutes. Then we'll turn to a more formal introduction of our guests in our discussion today. First, we have up here on the screen a picture of the U.S. monthly unemployment rate, which, as you know, is now 8.5% nationally. This picture is one of many ways we could look at it. We've broken things down by age of individuals. You can see that individuals who are 16 to 24 years old have a much higher unemployment rate than more senior workers, but also that this most recent recession has been more severe for the labor market than we've seen historically, and that's true of all of these demographic groups. Secondly, there's much more beyond the standard unemployment rate. And as an example, we've plotted here, just for the last couple of years, that the unemployment rate that's typically stated we know now is 8.5%. But if you look at other statistics, for example, including people who are working part-time because they can't find a full-time job, or those who've looked for a job in the past 12 months but not in the past month, that more, instead of 8.5%, more on the order of 15% are basically seeking more work, unemployed or underemployed. The next figure, there's just one more after this before we get to our guests, is median household income in the United States. While increasing somewhat during my lifetime, which is basically, my lifetime's a little bit shorter than this graph, but during this graph, has been relatively flat for some time. You can see since the mid-1990s, the median household income in the U.S. has been relatively flat or even falling. And finally, this is the civilian labor force. Now, the horizontal axis in this graph is a little bit shorter than those in the other graphs. And you can see that while we all know that the U.S. population's been increasing, the civilian labor force was increasing for some time, but has been relatively flat, especially most recently. So now I'd like to introduce our two guests. I'm going to serve as the moderator today. The first is Stephen Berkenfeld, who is a Cornell ILR graduate from 1981. He's the managing director of the investment banking division at Barclays Capital. He graduated from ILR during another extraordinarily severe recession in 1981. And second is Frank Koller, who's an economic journalist who's written a very interesting book called Spark, which is about Lincoln Electric and their no layoff policy. And we're going to be turning to Lincoln in part of our discussion today. So first I'd like to turn to Stephen and say, what do you think about these statistics? We're no longer technically in a recession, and what do you think about these statistics and what's going on in the labor market today?
Well, in the State of the Union last night, President Obama said creating jobs and stabilizing our economy, restoring our economy, are the defining issue of our time. And if you look at all the different metrics, whether it's the duration of unemployment, whether it's the types of jobs that people are getting when they are reemployed, getting a lot less in pay, getting part-time jobs. If you look at 6.6 million fewer jobs than we had 4 years ago, The rate of job growth is somewhere around 140,000 a month over the last 6 months on average. That's not enough to keep up with population growth, so we're not making a dent in overall employment. There was a McKinsey report recently that said we need about 40 million jobs in the developing world to get back to the same level of employment we had before, and a view that the data doesn't support that job growth, economic growth alone will create those kind of jobs. So there's something different around this recession, where we've had an increase in corporate profitability, we've stabilized their balance sheets, they're sitting on a lot of cash, the economy is growing modestly, but we haven't really seen a change in the employment levels. And when you look at the unemployment, which I think very much understates the issue, and compare it, you had how many people looking for more work, but with the overall underemployment level and underemployment among the young in particular, and you look at the people who have part-time jobs and temporary jobs, they're working for less, they're getting less benefits, I think it's a much more significant issue for the economy.
Okay. Now, as many of you know, we've prior to the webcast, we sent a survey to those who were going to be participating. And although we have on the order of 1,000 people who've registered for this, this preliminary survey that 160 individuals responded. And one of the questions we asked was, how has technology generally, and advances in information technology in particular, changed your organization's need for and utilization of employees? And you can see here on the screen some of the responses that some of the individuals, those 160 people who have responded have said. And I'd like to point out two things. One, this is a pretty self-selected sample. These are people who, many of whom are very interested in the labor market and employment, some of whom are ILR graduates. This is not a scientific survey. But Frank, I'd like to turn to you to start to ask, what do you see, what do you take away from these kinds of statistics?
Well, I think the first thing, Kevin, that struck me in reading through it was not so much the area that Stephen has already alluded to and is going to talk about in more detail on productivity and whether or not it creates the need for jobs. But if you look through this list, two things. First of all, there's not a great emphasis that the increase in information technology has explicitly improved human creativity in the workplace. And in fact, more detailedly, if you look at what the words being used in the answers are about, forced change, more reactive, less proactive, increased hours, automation. And I think that, speaks to a sense in many types of work across the American economy that people are just not as engaged as they would probably like to be. Whether or not that's improving creativity or productivity is a separate issue, sadly.
Right. Stephen, does something strike you from these?
Well, a lot. And clearly technology is having a very significant impact on work and the nature of employment. We can balance work and the rest of our lives easier. We can work remotely. On the other hand, work's become more of a 24/7. You're connected all the time. It's become more reactive. But I think the critical issue for what we're talking about are the jobs coming back. And you look at unemployment so high for so long, underemployment so high for so long, you say, what's causing it? What's different about this recession, this downturn, this crisis than all the ones in the past since the Great Depression? And my view, at least, is that a big part of this is the impact of technology and the advances in technology, in particular information technology. And if you look at the responses here and say 63% who respond to this when they're looking at their organization said that technology has allowed for more automation of human-done processes. 25% are already identifying that it's eliminated the need for certain classes of employees, enabled greater productivity, and permitted a greater use of outsourcing. And I think outsourcing and offshoring is not just other countries, but outsourcing of fundamental tasks that were done within a company that are now outsourced, like billing or like payroll. And you look at this all together, and then you start looking at some of the statistics, like in the last decade from manufacturing, American factories have increased their production by 1/3, while the number of jobs have declined by 1/3, right? So how do you reconcile that? You look at automation, productivity, outsourcing, and you see that they're very powerful tools if you want to use them to reduce your workforce and to eliminate jobs. So I think you take a view of how do we use people, how do we treat human resources, Is the goal to cut costs and to use those human resources as efficiently as possible? And if so, we can use technology to do so. I think there's been a lot of discussion. There was last night in the State of Union around manufacturing jobs. I think where it's really having an impact is on the service sector. And if 70% of the jobs in this country are service jobs, and we start thinking about how has technology changed that? How has it changed the retail sector? How has it changed banking and finance? The job of bank tellers or toll booth collectors or token clerks, you go on. And everyone can see on a daily basis how much technology has come into providing those services. And I think we're just starting to scratch the surface here. But what is really interesting is when you take all of those ways that you can use technology, it can have a really dramatic impact on how you then, on the other hand, use workers and the jobs you can eliminate.
Or not use workers.
Right.
Right, absolutely. So the next thing that I'd like to turn to, often what comes up here is some tension between shareholders, workers, what's important, what is the goal of an organization, what is a corporation, nonprofit organization, and so on. So on the screen here, there are two sets of lines. For those of you looking in, don't worry about the two sets. They're two measures of something that I'm going to tell you about in a second. This is based on work that I've done with Henry Farber, who's a professor at Princeton University and an ILR grad, where we collected information on 5,000 job loss announcements for all publicly traded firms, all firms in the Fortune 500 over basically a 40-year period. And we wanted to look at what was the share price reaction to a job loss announcement in the firm. Firm X lays off 5,000 workers. What happens to the stock price the next day? We actually looked at just a 3-day period. We controlled statistically for what the market was also doing, using something called an event study method for those out there who might be interested. And then we basically tallied up what was the average share price reaction to all the layoffs that companies in the Fortune 500 made in that year. And this graph shows that basically in the 1970s, on average, there was a negative share price reaction to job loss announcements. And that's become sort of monotonically less true over time. It was negative in the 70s, maybe for reasons of deficient demand. People aren't buying large American automobiles in the 70s with the oil price shocks. And into the 90s, maybe this is an efficiency or a right sizing or a downsizing kind of thing. And I think the public perception of what a layoff meant has changed as well. But basically, this graph showing using 5,000 job loss announcements that there was a negative reaction in the past. It's now basically zero, maybe weakly positive on average. That the share price reaction, although sometimes goes way up, sometimes goes way down, on average, very, very small stock price changes to job loss announcements. And Stephen, you work in the finance industry. I wonder what you think about this. If it doesn't seem to be helping companies so much in the short run, what's going on?
Well, it is clear that's not absolutely positive, and the stock isn't necessarily going to react in a positive way. I think a lot of it depends on why. So a lot of companies do announce layoffs, and it's perceived by the market that says something about their growth opportunities, right, in the future of the business. You have to lay that in. But I think what's interesting is that the nature of layoffs have changed. They're not just around downsizing into a downturn or slower growth or some sort of pressure that's put on a company. You now have productivity layoffs. You have companies, and there was an article in the New York Times not too long ago really focusing on the issue of companies announcing layoffs concurrently with stock buybacks, which in my mind should be somewhat mutually exclusive. A company saying we have more cash than we know what to do with, we don't have a place to invest it, we're going to buy back our stock, yet we also have to lay off hundreds or thousands of employees. You have a lot of layoffs that come out of M&A transactions. An important part of the rationale for an acquisition are the synergies that you can generate, and synergies are a euphemism for cutting costs, and most of those costs you cut are laying off people where there's duplication or where you can just get more efficiency out of it. And I do think that layoffs are still something that, in my view, are relatively hard for a management team to put in place, and that you need some sort of rationale to do it, some sort of impetus. I think a recession does that, allows companies to say that we have to let go of people, but it's not just about what we expect to happen with our top line. It's also about how do we rationalize our workforce so that it fits better with the advances in productivity we've made through technology.
Frank?
If I could just add one thing, not necessarily in disagreement with Stephen's point, but I think that I remember reading your research a couple of years ago and seeing, in a sense, how, in a way, layoffs have become normal. And I think, there's a number of reasons why the market is perceived. I mean, maybe we know 70 or 40 or 50 years ago, the idea of companies laying off, in a sense, was very clearly breaking some kind of social contract. But I think there is an element here where the trouble with normal is that it always gets worse. And I think we've talked so much over the past couple of years about what's business culture in America and what Wall Street culture is. And I think that is a component there, that the idea of layoffs have become more a commonplace strategy for, not callously, but it is on the desk.
Well, switching to the next topic, I think that's true.
Before we go to the next topic, though, I think just one point I'd want to make, and I think it's this impact on jobs from technology has been going on for a while. I think that you've seen the acceleration because of the recession. It did give companies the opportunity, all companies, and there were small companies, larger companies, companies involved in technology or healthcare that were also going through layoffs. Companies that really weren't as affected in their core business than ones involved in manufacturing, for instance.
Right.
Yep. And all of them said, the economy is tough. I can now look at my workforce and say, how many people do I really need, and where can I eliminate, where can I use my human resources more efficiently because of technology, because I've been able to outsource, because I've been able to automate.
I was actually fascinated with not this recession, this most recent recession, but the one prior. I went to visit a startup company. A lot of technology workers, young workers, very highly paid employees. There were about 2,000 workers at the time. I was interviewing managers about experiences with layoffs. How do they do it? Why do they do it? When do they do it? And I was interested in the stock. It was background for the stock price kind of paper. And I interviewed some senior managers who were talking about people who were, the managers themselves, very upset, never been through a layoff. People were very emotional. People were crying. The managers themselves. I went back 6 months later to the same company and interviewed again, and they had the attitude that, this is the way of the world. This is how it has to be, and we've got to cut or we're all going to lose our jobs. And so what I'd like to do is turn to a company that's not doing that. It seems to be behaving really differently, and I'm going to have some questions for you after you introduce the place, Frank. But it's Lincoln Electric, and so what I'd like to do, maybe Frank, you could introduce Lincoln Electric briefly, and I just want to tell the audience members we're going to show a video that's about 3 minutes, which is a little clip about Lincoln that was originally broadcast on PBS NewsHour, and then we'll come back.
Sure.
Go ahead.
Well, what got me interested in this company, I just happened to stumble on it about 15 years ago, but as a journalist, I've covered in the US and in Canada and overseas a lot of layoff announcements. And inevitably, almost the last thing a CEO will say when he or she announces a layoff, ultimately, after they told how many percent they're going to let go, is they say they have no option. And so when I happened to stumble across Lincoln Electric 15 years ago, this was a large company that simply doesn't lay people off. They feel they do have an option. Lincoln Electric has been since, it started in 1895 in Cleveland, where they are still located. They are now a global company with production facilities all around the world. Since the 1930s, they have been the largest, the market share leader, and the generator, most people would argue, of the best technology in a very evolving field of welding, which is used, every building we're all in and in space and around the world. There's a number of reasons, obviously, why they've maintained their leadership position over the years. Obviously, the best technology is the key one, but they would argue that a key advantage, competitive advantage, is how they have dealt with their internal HR challenges. And a key element of that has been what they call the guaranteed employment process or the no layoff policy. And the promise there is, I was going to say very simple, it's not because it's difficult to do, but that no permanent employee after a probation period will ever be laid off for lack of work. That no matter what happens, if the economy stumbles, they will find ways to keep their people on the job inside the company. That's going to mean a lot of sacrifices, it's going to mean a lot of flexibility across the workforce, but they've been, since the start of the firm, committed. And they still feel very strongly now that we dramatically undervalue in the American economy the value of longevity on the job and the competitive advantage of knowing your work well. And so Lincoln formally has not had a layoff for economic reasons. I mean, they will let people go if you don't perform, but hasn't had a layoff since 1948, perhaps much longer. That's meant that their workforce turnover is a fifth, a sixth of what the industry averages are. And again, and it's a point to emphasize, since the 1930s, they've been the best, the biggest, and for virtually all that time, they've produced a profit and the most profitable welding company in the world.
Okay, so now we're going to turn to the video. It's just going to be 3 minutes, 3 minutes long. We're going to show the plant floor, and then I'm going to come back for some questions for both of you about Lincoln Electric.
A bright light in Rust Belt America. Lincoln Electric, making welding equipment in Cleveland for over a century. 4 million U.S. factory jobs lost in a decade. 250,000 in Ohio alone. Yet here, they protect jobs, and did so even through the crash of '08, says CEO John Stropke.
We did not lay off any of our employees during that tremendous recession.
That's because after 3 years, workers here are guaranteed at least 30 hours a week as long as they continue to meet quality standards. Workers are not paid by the hour, but by output. The piecework system, once common in manufacturing America. Kim Mattina has been a piece worker at Lincoln for 7 years.
Other people would like to be on an hourly job where there's no pressure there. They just get paid no matter what they do.
Here, the pressure's always on, because if you don't do, you don't earn. And since time is money, even lunch breaks can become too costly. Brad Barnes eats at his workstation.
I like to be close to my work and get done eating and get right back to work again.
So this is an efficiency move on your part?
Yes. Yep.
How many people here in the factory, or what percentage, do what you're doing?
I'd say more than half.
Furthermore, overtime is at the company's discretion, not yours. The amount of work dictates the length of the shifts. 15-year veteran John Fozzi.
It's just long hours. When you get busy, get busy. So you got to take the good with the bad.
While workers at Lincoln today work hard to produce as much as they can, the piecework rate is forever being cut to reflect productivity improvements.
Nobody wants to get their prices cut, but it's usually for a reason.
You figure it's fair enough.
It's fair enough. I mean, you have to be fair to the company for the company to make money.
But wait, why care about the company making money? Because in exchange for the rigors of piecework come job security and profit sharing. Though its stock is publicly traded, Lincoln sets aside a full 1/3 of its earnings for a bonus pool.
That is shared by all full-time employees based on their wages earned during the year and then based on their performance. If they make more parts, they get paid more. If they help us generate more profit, they get paid more. This system is harder to manage than other systems are. To have to come in the worst of a recession or depression and think about how you're going to preserve the jobs of 2,000, 3,000 employees is not an easy system to manage with.
Piece workers say the system's also too tough for most workers.
I know personally, nobody in my family could do the job that I do. And I would think maybe only a third of the people out there could actually survive doing piecework.
Novella Todorov's been at Lincoln for 12 years.
We have a lot of people that do come and they don't make it.
And they don't make it why?
Because we're hard workers.
Harder than the average?
Yes, much harder than the average.
For more than a century, Lincoln Electric has made money the old-fashioned way and is on track for $200 million in profits in 2011, while offering its workers essentially lifetime employment in still somewhat rusty Cleveland, Ohio.
Well, so Frank, the first thing I'd like to ask about this is strange because there are small. This is a publicly traded company, so it's unusual. But there are small manufacturing companies, small companies where the owners are basically sharing their profits, sharing their rents with the workers, and letting them sort of, rather than philanthropy in other ways, they're giving the money to the workers. Is that what's going on here? It seems unusual.
Well, absolutely. And I always, in a sense, have to re-emphasize this point, that this is a large company that is not immune in any way to the market forces that buffet the economy as a whole. I mean, this is not Steve and Frank's bicycle shop, but we're going to keep you on working no matter what because we're all a nice bunch of people and we'll make those sacrifices. This is a firm that has to deal with the fact that they have competition, and so in that sense, it's a real company. But it really calls into question if a firm like this can compete against the best in the world and be the best in the world decade after decade, then you can't really say that, well, I agree, it is not common practice, but it's not something from Mars, and they don't operate on Mars. They operate in the heart of the American economy.
Right. And Stephen, we've got a lot of people interested in labor markets and human resources on the webcast with us. Do you think this can work anywhere else? Is this the model for others?
Well, it's a complicated situation. It depends on culture. I just read Frank's book, and it's terrific and really got a good understanding of what they're doing. I think a broader comment is that corporations have as a mandate, as a matter of policy, to use resources as efficiently as possible. Raw materials, energy resources, capital resources. That's spread to the overall economy and society. Human resources are another type of resource.
Absolutely.
And you should try to use it efficiently. I think that for a lot of companies, that means if I have productivity gains, I can get rid of some of my employees. If I have technology that's cheap enough to buy, right, so it pays for itself in the right kind of time frame, good return on investment, I can get rid of employees. If I can ship the work out to another company to outsource it and get rid of some of my employees, I should do that. I think that Lincoln also uses human resources as efficiently as possible, but they do it a different way. They really are focused on the efficiency of those workers. They're probably more efficient than any others, but they have a very different approach to how they manage their human resources.
And I think, Frank, that I'm interested in compensation. We have the Institute for Compensation Studies here at the ILR School. This is variable compensation. And
Absolutely.
on a previous slide, there's huge variability in the pay. So I think two things strike me as unique about the place. There's dramatic risk, one type of risk for the employees, and that is that there's huge variability in their income from year to year. And it doesn't strike me that this is just going to work everywhere, because those workers strike me that on average they're very serious about their work and they're very good. They're very highly, they are the best workers of that type, I would imagine. They're willing to work hard.
Absolutely. I mean, Lincoln, would certainly not argue that this kind of internal management system is appropriate for everybody. But a couple of points. First of all, there are other companies and significantly sized companies in the American economy that have variations of a no layoff policy. Southwest Airlines, huge company. SC Johnson, Marvin Windows, probably half our audience has got Marvin Windows in their house. So it's not just in a strictly manufacturing environment that these kinds of things work. But the question of flexibility is really important. I mean, there's two ways to think about this. As workers, what is of the greatest value when we think of broadly our futures and our families? Income security, which may imply that you have fixed salary for a couple of years, but you could get fired, or employment security, which is a situation where you embrace the ups and downs of the marketplace because that's how the company's profit moves up and down. But you know that over the years and over the decades, you have a sense of security, both personal and as a result for your family.
Right. Okay. I'd like to turn now to another survey question that surprised me a little bit. One of the questions that we asked in our pre-webcast survey, remember, non-representative sample, this isn't a scientific thing, this is what those of you who wrote in had to say. Separate from the recent recession, how would you characterize your senior management's views of layoffs or downsizing? It was interesting to me that 51% of our respondents said it's a last choice response to a business downturn. And I've been teaching at a university for 17 years, and I remember when I first started in 1995, I would talk with students about that sort of thing, and I think the views really changed over time. And I wonder what you two, maybe we'll go to Stephen first, what your thoughts are about that kind of a response. If employers are really, if you think that's whether we've got a select sample.
Well, you start over and say it's not very scientific, and it's not. I mean, this surprises me a lot. There's a lot of layoffs, downsizing, cutting of costs going on, even in good times. And we talked about the stock buyback. I mean, at the beginning of the year, there were some predictions that of the S&P 500 companies, they would see slower earnings growth, right? So earnings are still growing, but they're growing slower. And each of those articles concluded with, well, how are the companies going to respond to that? And they're going to respond to that by cutting costs. And when you look at things like natural resources costs, which are going up, right, as there's more demand for them on a global basis, it really comes down to what costs can you cut. And the costs you can cut are your workforce, labor costs. And how do you do that? Do you outsource more? Do you look at ways to enhance your productivity? Do you adopt new technology? But these are going to be layoffs and downsizings and restructurings that are going on all the time as companies are looking at how to be as efficient as possible, how to be as profitable as possible, and not having a lot of different dials to turn to get to that. So even though they're sitting on a lot of cash, companies, profitability is at record levels, cost cutting is still up there as one of the top things for them to continue to be considering to enhance that profitability even further.
Now, Frank, you've been covering layoffs for a long time, prior to your book Spark, but were you surprised by this?
I was quite surprised at this. I mean, yes, we have this is not a representative sample of the public, but just a couple of comments. First, there is a very active debate in your world of economics as to whether or not the pace and the severity and the scale of layoffs has increased over the past 20 years, or say since the 1980s. So that's a real debate, and it's not actually clear. But I don't think there's a debate, and I don't think anybody listening in, or most Americans, would think there's a debate that there's a perception that layoffs have become more common and are just more normal. So what struck me here is just two things. I mean, first of all, this is people who answered the questionnaire on their senior management's view. Boy, I think they're a bit optimistic about what the people that are at the top of their corporations are thinking day to day. And the second thing is, in a way, I don't mean to be critical of the question, but surely recessions are the test as to whether or not ordering a layoff is a last choice. And so in a way, I'm quite surprised by the results of this survey.
Well, what we've just said, or you've both commented that, you may be, it's not a scientific survey. I'm going to give you something less scientific. I'm going to give you two quotes. So it's just two individuals' opinions. One is the CEO of Lincoln Electric, John Stropke, who we've just heard from on the video, who said, I don't think of how we operate as a social responsibility. We can spread the pain in a way that long-term will better represent our shareholders' interests without crucifying our employee base. So he's trying to say, in some sense, that you can have it both ways. I'm going to give you one other quote from William Anders, who was the CEO of General Dynamics in the early 1990s. That's part of a case study from Harvard Business School, where in which I use this case in many of my ILR classes, where he said, I do not see that we have a social obligation to our employees. This is an issue of excess human capacity. We trained our people to have specific skills and paid for that training. We paid them for their skills. What are we to do when their skills are no longer required? That's not our business and not our obligation. What's interesting about that quote is I've been reading that quote and things like it and things related to it to my students for the past 17 years. And when I was first doing it, I think the students were quite shocked that this was a leader of an American corporation saying something like that. But now they're not. I think now I do the same quote, same kinds of kids. They're just a generation later, and they're not at all surprised by that. I wonder what you think about that, Steve.
Well, I think this quote, even though it goes back 17 years or so, it very much reflects a shift in the prioritization of companies towards shareholders and profitability and away from employees and perhaps the community too. There's been a lot of talk, and I know we're going to cover a little bit more, but how U.S. lost out on iPhone work, which was in this weekend's New York Times. And a lot of people who are interested in this topic have been referring to that article. It's very well done. But there's a quote in it from an Apple executive, unnamed, that says, we sell iPhones in over 100 countries. We don't have an obligation to solve America's problems. Our only obligation is making the best product possible. So there's nothing wrong with that quote, but companies, I don't think, feel the same obligation that they should be part of this overall social contract and responsible for making sure that jobs are created and that we have what we consider to be full employment. That's not their responsibility. That's their attitude now. And if it's not the company's responsibility, and if growth alone is not going to create those jobs, then whose responsibility is going to be? Where are those jobs going to come from? How are we, in a very competitive global economy, going to create jobs relative to China or Korea or Vietnam now, or wherever it may be, when every company is saying our only responsibility is to our customers and to our shareholders?
Well, that is definitely the view in much of, the world that Stephen is an expert in, which is, finance and Wall Street. Just a little story about my interactions with Wall Street. I went and talked to 5 of the key industry analysts in the finance world in the American economy. 3 were in New York, and the others were in Chicago and in Cleveland. These are all people who regard Lincoln Electric as one of the best managed companies in America, certainly in the manufacturing area, and are quite happy in recommending CalPERS, the California Pension Fund, invest tens of millions of dollars of their stock money and their pension funds in Lincoln because it's a solid performer. So I asked them, do they ever tell CalPERS or some other big client they're wooing that Lincoln feels that its competitive advantage is a no layoff policy, or one element of it? Dead silence. None of these guys knew anything about this aspect of how Lincoln runs internally, and in fact were quite aggressive when I explained what Lincoln does. And their attitude was that this is gaming the system, that there has to be, as a result, an unfair advantage for workers at the expense of shareholders.
Right. I'd like to ask 2 questions. One person wrote in and has asked about unionization. Yeah, so it's a very specific question. Is there a union at Lincoln, and how has that played out over time?
No, there's never been a union at Lincoln. Been a few attempts over the years, but as Rich Trumka, the head of the AFL-CIO, told me, why would I waste 10 cents of scarce AFL-CIO organizing money to organize Lincoln in a union when they've already had what people have died for over the past century in the American labor movement?
And another one, it's related to the industry, but I'll ask you, Stephen, if one of the people writing in is asking basically an industrial organization question about the fact that is part of this story for Lincoln Electric, do you think, because of the difficulty of getting into the industry? Do they have such a market share? I don't know, Frank, you know what the market share is.
Their market share is only about 15% globally, so they have competition, tough competition.
I think they need to remain competitive like every other company. Again, different strategies. They are using human resources very, very efficiently. And the people work hard on it. There's piecemeal and profit sharing. That's their strategy for incentivizing their employees to be as productive as possible. And so they are doing it. I just, on this quote, there's one other point I think it's worth making. And I look at this as what I would refer to as kind of a classic collective action problem. If you have each company saying that we need to cut costs to be as profitable as possible, and that means we may need layoffs. And I think that's fine for each company because they are focused on their profitability. But when you combine that and every company takes the same view, that we need to be as profitable as possible, and if layoffs is the best way to do that, using technology perhaps to get there, then we do that, then you look at what the overall impact of the economy is. So it's very logical for each company to take this approach. When everyone does it together, it's not very logical for our economy as a whole.
Okay, great. I want to switch to the performance of the company. So I've drawn a picture here that you can see on your screen, which is basically 4 different lines. They're Lincoln Electric's, it's a publicly traded company, their stock price performance since basically in the last 10 years, along with the S&P 500, the Dow Jones Industrial Average, and the NASDAQ Composite Index. And this is not a selectively chosen time. I just took a decade. And you can see here, Frank, that Lincoln's done pretty well. Obviously, there was a dramatic decline in stock price for a manufacturing company in 2008, but then has recovered quite nicely, and over the last decade has done quite well relative to a general index. But I don't know, and I think a skeptic would say, this doesn't necessarily mean it's because of their HR policies. I wonder what you, given your knowledge of that particular company, how you feel about that.
Well, I think first of all, the company will say themselves, although they're not proselytizers about how they run themselves, but they do talk that this gives them a significant competitive advantage. I think the evidence speaks for itself, both in terms of how the stock has done over the past, in this case, 10 years, and in terms of how, as I said, they have been able to maintain their market share and generally acknowledged as being the best generators of technology in evolving industry, global industry. But I think there's an important point, and you know, we were talking about this before we went on air, that it's, you know, if the graph had gone back a little further to 1995, all of a sudden Lincoln wouldn't have been there. And that's because for the first 100 years of Lincoln's existence, they were a privately held company. And interestingly is that many, if not most, of the companies that I've come across that have these kinds of creative HR policies tend to have stayed away from the equity markets. They've operated
public
privately.
ownership.
Yeah, and that's, you know, obviously this is Stephen's territory.
Well, as a public company, you just have a lot more pressures from investors and research analysts to perform on a quarterly basis. And so you have to say we're trying to maximize profitability. And perhaps with a somewhat different human resource policy, the profitability could have been somewhat higher at Lincoln, maybe. Maybe the stock could have been a little higher. I would look at this and say, isn't this good enough? This is good performance for a public company. And so there are ways to continue to increase your share price and get return to shareholders without having, as a necessary part of your management of human resources, regular layoffs.
What I'd like to switch to quickly, Stephen, you mentioned a little bit earlier, is there was an article, I think it was in the New York Times this weekend, that was talking about iPhones, whether they're made in the U.S. So I'd like to, and the President mentioned last night reshoring of jobs back to the United States. I'd like to ask that and also throw out there at the same time, I'm going to start with Stephen, that one of our participants has written in about the unemployment rate strongly being related to the U.S. Becoming, whether that is related to the U.S. becoming a service economy. And where European countries have had much different experiences and maybe have different higher unemployment rates. Is there an economic shift that's occurring in the economy? And this person writing in is also thinking about whether this recession might actually be, this most recent recession really is changing the game.
Right.
In particular with things like the technology in manufacturing, when most iPhones are made in China.
Oh, I think the question's very much on point. I think that we are, because we are such a service-oriented economy, and now we have these advances in information technology, that they've really started to change the way that we need and use service workers, and it's really had an impact on service jobs. And I think that's what you see as much as anything in this recession and then the consequences of it, and again, using the recession really just as a way perhaps to accelerate this layoff trend and this adoption of technology and rationalizing your workforce. And we should talk about manufacturing, because it is a part of the economy and there's a lot of jobs that come out of it, and you still need an economy that produces things. It can't all be service. And I think reshoring is encouraging, and I think it will help create some jobs, but you got to pause and say, well, you know, what's happening with this reshoring and why is it happening? And the factories that are being built now, the new factories, are just creating so many fewer jobs than they did in the past because of automation. There was an article recently about a new GE solar panel factory in Colorado. It's got a capacity of 400 megawatts, which is tremendous compared to the demand overall for solar panels in this country. The size of the factory is 11 football fields, right? And the report in the paper was that facility is only going to create 355 jobs. You think of 355 jobs in a facility that's the size of 11 football fields. You know, not to get controversial and not to go off point, but you look at a company like Solyndra, right? There's been a lot of news about Solyndra, and Solyndra wasn't successful. But the thing that's interesting about it is that, you know, the estimates I've seen is that Solyndra, with 1.4 billion of capital, right, including the equity that was invested in it, was only creating about 1,100 jobs. That's about 1.3 million per job, right? It's because there's a lot that needs to go into these factories, a lot of automation, a lot of technology, but they don't create a lot of jobs. And the reshoring, and I'm sorry for going on a little long on this, is interesting when you just conceptually think about the math of it, where, you know, in the past, there might have been a manufacturing facility in the United States that employed 500 workers, paid $23 an hour, right? And you could argue about this, but they were getting paid more, industrial workers that. So you had a kind of an hourly labor cost of 11,500. That gets moved over to China. China has 1,000 people instead of 500. If anyone's been in China and seen the factories, yes, they use their labor much less efficiently. I think they do that deliberately. And they're paying them $1 an hour. So you have 11,500 of the labor cost in the United States versus 1,000 in China. All right? So now, yes, China's gone up a little bit in labor costs. It's gone to $1.50, so now it's $1,500 per hour. But you can take that facility, bring it back to the United States, and use only 100 employees because it's become so automated. And 100 employees with the lower rate, because you have surplus labor of, let's say, $14 an hour, is about $1,400 in labor costs. So it's actually less in labor costs than it is to manufacture in China.
Right. Yeah. One I think, point that we haven't made here is the idea of comparative advantage and the benefits of international trade.
Right.
I don't think we have time to get into that, given some of the points people are writing in here about, and the next question I'd like to go to, which is completely consistent. In fact, the three things on this next slide are, what about policy? There are three that I've written down, three possibilities: regulation, retraining workers, and work sharing unemployment insurance. I'm going to talk about each just very briefly, and then ask for your reactions. I mean, one obvious thing could be that we're losing jobs in manufacturing, and we've seen proposals where maybe we can retrain workers to work in community colleges, for example. We have a massive system in the United States to retrain workers for jobs that are more in demand these days. Another are issues of regulation. So there's several people writing in here about the experiences in Europe with certain policies having lower unemployment rates than in the U.S. now. I interviewed a CEO a couple of years ago for a project on layoffs who said, in fact, it brought up an unintended consequence. Well, he said, I'm never going to hire anyone in France again because you can't fire them. There's nothing you can do about it, even for productivity problems, for example. And the last one that a couple of people have written in about is work sharing unemployment insurance. So there's a policy that's common in some European countries, and it's also available in the U.S. in 17 states, called work sharing unemployment insurance. I know you guys know about this, but I'm just going to say it for some of our listeners, that basically imagine a plant thinking about laying off 10% of its workers, and those workers participating in unemployment insurance. An alternative could be to lay off all the workers 10% of the time, and they could be in a prorated unemployment insurance system. It turns out that very few organizations use that. So we only have about 10 minutes left in our time, and there are a couple of other things we want to get to. But I'd like to talk for a couple of minutes about what you think about these policy responses and where that might be going. We'll start with you, Frank.
Well, I find the challenge of, in a sense, I guess I would argue, increasing the use of work-sharing programs really interesting. As you mentioned, there are, I think, 17 or 18 states that have these programs.
It's probably 18, but I said 17.
No, I thought, two things. First, they're not, most states will tell you that they're not being fully utilized.
They're certainly not.
And of some of the states that they are, they'll say they never had very much money to work with in the first place, so they weren't able to really deal with
firms they seem to not want to participate for a variety
exactly.
of reasons.
I do think this also speaks to this challenge of how we think in the United States. And I should say, as a Canadian, the work-share programs are quite a bit more robust in Canada. But here in the States, it does bring up this question that I chatted about before. In a way, it's a cultural, small e economic question of how do we think of income security versus employment security? And we do face these all the time. Interestingly, in the president's in his inaugural speech 3 years ago, in 2009, he talked about that, about sharing jobs, somebody willing to give up hours to share it with another worker. These are not long-term strategies for creating jobs, but in terms of mitigating the effects of layoffs and people suffering, these are tough questions to figure out. Do we put a lot more resources into these programs?
It's difficult. In the organizations that I've interviewed about this, I'm an empirical labor economist, so I'm not expert on interviews, but I've been doing some of these interviews. And some of the firms say they don't want to do that because what happens is, rather than getting rid of the 10% and they're gone, of course there are things like survivorship bias, it's called, of the employees who are remaining, but they'd rather have some workers upset and gone than everybody upset. So what do you think about that, Stephen? Is that part of what companies why there's some resistance to work sharing unemployment?
I think so. I think so. I think it, poll them, they'd rather say I've had my full job. I need my full job. Again, their wages have come down, right? And 10% or 20% of a cut is significant. And I think we've just got more in the habit of let's cut those people, let's announce those layoffs, not that we've cut everybody back 10% or 20% as the way to deal with these issues. Just to deal with some of the others, look, I don't think regulation is the answer. I don't think you just regulate it. I don't think it's politically feasible, first of all, and I don't think you're supposed to be telling companies you just can't do this. I think retraining is, and I think we're putting so much emphasis on it, I think it's a bit of a red herring. And I think it's a little simplistic. There is a skills gap. There is an information gap of where the job's available. That gets into issues of worker mobility when houses are underwater and you can't just go sell it. You lose money and move to, from Cleveland down to Texas to get a job because you just don't have that economic mobility. But more important, when you think about retraining, the great article in The Atlantic this month by Adam Davidson, it's called Make It America, which talks about the skills gap and what a highly skilled worker needs to do and a less skilled worker and what it takes to be a highly skilled worker. And to think that you're going to take people who are out of a job and turn them into a highly skilled worker with the background they need, the education, the training and science and math, who's going to do that training? What are they going to be trained for? Are they going to be able to take time off to go through years of training? Because these are really demanding jobs. And then once they're retrained, who's going to hire them? I mean, I use this as the best example. The Postmaster General has said that he would like to lay off about 120,000 postal workers because the volume of mail is down about over 20% in the last 4 years. Mm-hmm. So we're going to take a lot of postal workers, let's say they're in the mid-40s or 50s, and we're going to retrain them to do what? And who's going to hire them? And some of the people who write about this just think they're all going to turn into guys who can design websites or iPhone apps. That's not what's going to happen. They don't have the skill set to do that, and they're not going to get it just by a 30-day retraining program. So retraining will help some, but it won't help enough. I think that this issue, what the poly response is very complicated. I think we need to start to just understand the issue and how much technology is impacting jobs. And then we need a national discussion, and we need to talk about rebuilding our infrastructure and energy efficiency and things like that as a short-term measure. But medium-term, longer-term, yes, a lot more investment in education, a lot more government R&D. We need to create new industries. It's very, very complicated.
This is a perfect segue to, I've participated in webinars before where I've done one on executive pay and then I go off and do something else. This is a webinar about, we only have 5 minutes to go and we'll be finishing on time so you can go back to work.
Being productive.
Yes. But we're going to continue this conversation. Actually, Frank and Stephen and Linda Barrington from the Institute for Compensation Studies and I are heading over 2 minutes after we finish here to Cornell's new Atkinson Center for a Sustainable Future for a topical lunch, which is going to include people from the Agriculture School and from engineering and business school and other places around campus for an interdisciplinary discussion about sustainability and human resources as a sustainable asset. We're also organizing a conference that Stephen and Frank will be able to attend in June of this year, where we're going to include policymakers, academics, practitioners, and others. And if you have any questions or would like to communicate with us, you can write to them at the web address that's on the screen. It's ics-ilr@cornell.edu. This will only be up here for another few seconds. But you can always go to the Institute for Compensation Studies webpage and find that web address, or write to me directly. If you have questions for these two as well, I'm happy to pass them along. So we look forward to that in just a couple of months, where we're going to continue working on issues of jobs in the new economy and technology and so on. So in the last 5 minutes, I'd like to go back to our beginning. So are the jobs coming back? What's going on now? And I'm just going to give a quote here, a little conversation between Henry Ford II and Walter Reuther, who was the head of the United Automobile Workers, as you know, where Mr. Ford said, "Walter, how are you going to get all these robots to pay your union dues?" And Mr. Reuther responded, "Henry, how are you going to get them to buy your cars?" In our remaining couple of minutes, I wonder if, Frank, if you have anything else you'd like to wrap up with, and then we'll turn it to Stephen and we'll be done.
Well, a couple of things. I mean, I think Stephen's absolutely right in terms of identifying, in a sense, the Uber problem. I mean, what I found so fascinating in the way Lincoln and a small number of companies are managing themselves, these no layoff policies, these will not solve. These will, in a sense, solve maybe or help to mitigate the layoff problems. But it doesn't solve the bigger challenges of the restructuring of the whole American economy with the technological challenges. That's the big problem. But that said, I think in what's always fascinated me about Lincoln and the others is that by any markers that we use in a capitalist economy to measure success, Lincoln Electric is an unquestioned success. It's been the biggest, the best, the most profitable for nearly a century now. So that's, essentially an indisputed fact. The difference I find is that by the markers that most of us as ordinary citizens use to measure success, Lincoln is a clear winner at a broader level. So I think as an example of trying to think about how we structure an economy, I think that's the importance of the Lincoln example, not copying them, but understanding that it is possible to protect people as well as profits.
Great, thank you. Stephen, any last
Well, the title of this is Are the Jobs Coming Back? And my view is that on their own, they're not. A growing economy is not going to create jobs. There just isn't that support. The economy has been growing. Companies are doing better. They're investing in equipment and in software, and the investment levels are at their pre-recession levels, right? So that's come back, but employment hasn't. We've lost a lot of jobs. We need to create a lot more, growing population. We do have this global competition. And so, my view is that, this is very complicated, but what I hope is that this is the start of a very broad national discussion on this, that we've agreed that creating jobs is priority number one, it's urgent, and how are we going to do it? And so part of that is what's been the impact of technology. And why is unemployment still so high? Why is underemployment so high? A lot of guys are trying to address the problem without understanding the cause, right? There hasn't been a lot of discussion on what is causing this, right? There aren't any other good answers in my mind. I haven't heard it, other than, boy, there's been a fundamental change. Going back to a terrific Vanity Fair piece that said, compare this to what happened in the Great Depression, when you displaced a lot of agricultural workers, and it took a decade and a world war to put them back into manufacturing, and nothing really changed employment until you got to that. I think this is different, and in some respects I think it's much more complicated, because then we had manufacturing for agricultural workers to go into, and over the last few decades we'd had service jobs for them to go into. I think now we really need to focus on it. The media is starting to write a lot of articles about it. There's not enough academic research. Love to get the Department of Labor to really focus on what's the impact of technology, what's the net gain of jobs, right, because there are new industries, but what are the net losses, because even the old industries and the new are using less people in those jobs. And then we have to start, I think, coming up with some very creative new solutions to how we address this. We have to rethink about education and retraining and government support for new industries and R&D, and what are the priorities of corporations, and how do we balance all of that. But we really do need some new thinking, some new ideas. It's a new paradigm, and I think that unless we address it head on, we're going to see an accelerating trend, and we're going to see more and more job loss.
Right. Well, I want to thank you both for being here. Frank coming down 4.5 hours from Canada to Ithaca, believe it or not.
Pleasure.
And Stephen from coming up from New York City. I appreciate it, and I hope we can continue the conversation.
Great. Thank you
And
very much.
Thanks everyone for joining us. And I'm sorry we didn't get to all of your questions, but again, the web address, the email address is there if you'd like to communicate with me or either of our guests. Please do that, and we'll get back in touch with you. Thanks very much.
Thank you.
Thank you.